Have you ever wondered how major investments shape the landscape of multifamily real estate in Canada's largest markets? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. Today, we're diving into some exciting news from Starlight Investments, a leading player in the Canadian real estate market. According to a recent article by CoStar, Starlight Investments is launching a substantial $750 million investment fund. The goal? To purchase purpose-built multifamily rental properties across Canada's largest urban markets. This ambitious move underscores the growing demand for multifamily housing in urban areas, driven by population growth and urbanization. Based in Toronto, Starlight Investments is no stranger to the multifamily sector, and this new fund is expected to significantly impact Canada's urban centers. Partnering with CIBC Investment Management, which is contributing $415 million in equity to the venture, this collaboration highlights the confidence investors have in the multifamily market. It's a testament to the resilience and potential of multifamily real estate, especially in a time when housing demand continues to rise. This fund is particularly noteworthy as it targets purpose-built rental properties, which are designed specifically for rental use rather than conversion from other property types. This focus ensures a more stable and predictable investment, catering directly to the rental market's needs. With Toronto as its head office, Starlight is well positioned to leverage its expertise and network to maximize the fund's impact across the nation. As we look at the broader picture, this move by Starlight Investments aligns with the ongoing trend of increasing institutional investment in multifamily properties. It's a clear indication of the sector's robustness and the strategic importance of urban centers in Canada's real estate landscape. For investors and stakeholders in the multifamily market, this is a development worth watching closely. The Canadian Apartment Properties Real Estate Investment Trust, also known as CAPREIT, is making a significant move in the multifamily sector by acquiring 5 multifamily properties, while selling 2 as part of its strategic portfolio overhaul. This shift is aimed at upgrading its portfolio to include newer and more premium real estate assets, reflecting a focused repositioning strategy. This recent transaction, valued at approximately $297 million, underscores CAPREIT's commitment to enhancing its asset base with high-quality properties. Among the acquisitions is a notable 320-unit apartment complex located in Regina, Saskatchewan. This move signifies CAPREIT's intent to expand its presence in key markets across Canada, targeting areas with strong rental demand and growth potential. CAPREIT's strategy involves a careful balance of buying and selling assets to optimize its portfolio performance. By divesting from older or less strategically aligned properties, CAPREIT aims to reinvest in locations that promise better returns and align with its long-term vision. This approach is part of a broader trend among institutional investors focusing on urban centers and high-demand regions, which aligns with the growing need for quality multifamily housing. This development is particularly relevant for stakeholders in the multifamily market, as it highlights the ongoing evolution of investment strategies within the sector. CAPREIT's move is indicative of the confidence that large-scale investors have in the resilience and profitability of multifamily real estate, especially in urban settings where demand continues to rise. For investors and developers, this is a key signal to watch as it may influence future investment decisions and market dynamics. In our final segment today, we're turning our attention to a recent development concerning the Morguard North American Residential Real Estate Investment Trust, which has been a notable player in the North American multifamily real estate sector. According to a report by MarketBeat, the Royal Bank of Canada has downgraded Morguard North American Residential Real Estate Investment Trust from an outperform rating to a sector perform rating. The bank has adjusted its target price for the trust to 21 Canadian dollars, reflecting a potential upside of just over 20% from the previous close. Despite the downgrade, there's a mix of sentiment among analysts. TD Securities has raised its target price for the trust to 24 Canadian dollars, maintaining a buy rating, while Desjardins has revised its target to 22 Canadian dollars. This indicates a moderate buy consensus among analysts, with some seeing potential for growth despite the recent adjustment by Royal Bank of Canada. Currently, the trust's shares are trading down slightly at $17.45 Canadian, with a market capitalization of over 600 million Canadian dollars. It's worth noting that Morguard North American Residential Real Estate Investment Trust operates across Canada and the United States, with the majority of its revenue coming from the United States. This diverse portfolio could provide stability and opportunities in the multifamily market, especially given the ongoing demand for quality rental properties. For investors in the multifamily sector, the mixed analyst ratings and recent price adjustments offer a nuanced picture of the trust's potential. While there are challenges, the underlying demand for multifamily housing remains strong, and Morguard's positioning in both Canadian and U.S. markets could be a strategic advantage. As always, it's crucial for investors to consider these factors and conduct thorough due diligence when evaluating their investment options. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.